Welcome back to Investing Talk Podcast.
Today we're looking at Hertz. The big question is it a good time to buy now?
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis, and we really need to start by setting the stage here. I mean, Hertz today, it's not the company maybe people remember.
Definitely not. It's coming out of some serious historical challenges, right? Bankruptcy, huge debt.
Exactly. And they're still technically sitting on a pretty big trailing 12-month net loss, like $2.55 billion. That context matters.
It absolutely does. Because when you see those Q3 2025 earnings against that backdrop, well, they didn't just meet expectations.
No, they smashed them, completely blew them out of the water. It was the first positive EPS they've reported in 2 years.
That's the headline grabber. 12 cents reported versus, what, 7 cents expected?
Yeah, a $0.12 EPS beat the $0.07 forecast. That's a massive 71.43% earnings surprise. And revenue beat, too, came in at $2.5 billion.
So you can see why the market got excited. Proof, maybe, that the turnaround plan is actually working.
That's certainly how it was received. The stock jumped, what, over 35% right away?
Yeah, immediate reaction. But here's the thing I keep coming back to. Was that just a great quarter, maybe driven by, a temporary travel surge? Or does it signal something more fundamental changing in the business itself?
I think it's leaning towards the latter. You have to look at the operational stuff underneath the headlines.
Okay, like what?
Well, fleet utilization hit 84%. That's a record high for them going back to 2018.
84% is really high for rentals.
It is. And they pulled in $250 million in positive adjusted free cash flow. That doesn't usually happen by accident. It points towards, better execution on a strategy.
And management's calling it a value-creating mobility platform now, right? Not just rentals.
Right, which, okay, sounds a bit like corporate speak.
Yeah, a little bit. What does mobility platform actually mean day to day, beyond just renting cars?
It means they're looking at the car itself differently. It's an asset that can make money in multiple ways. Rent a car, obviously. Fleet deals for businesses, service, and this newer mobility bucket, like rideshare stuff.
Okay.
But the really big shift, the thing that I think underpins the whole bull case, is what they're doing with Hertz car sales.
Yeah, it's selling the used cars. That used to just be about getting rid of old inventory, minimizing the loss.
Exactly. It was a cost center, basically. Now they're actively trying to turn it into a profit engine. They're pushing their e-commerce site hard, offering financing, delivery, even partnered with Amazon Autos.
Interesting. So how does that connect to making the core rental business itself more profitable? Because that seems key.
It connects through two really critical metrics, DPU and residual value. If you understand those, you understand the strategy.
Okay, let's break that down. DPU first, dollars per unit. Why is getting that below $300 a month so important?
Because for any company that owns a massive fleet of vehicles, the single biggest killer is depreciation. DPU measures the net monthly cost of having that car, initial price, financing, maintenance, minus what you eventually sell it for.
Right, the residual value.
Exactly. So if you can lower your net cost per vehicle, your DPU, you fundamentally improve profitability. Management wants it well below $300. Getting the average fleet age down under 12 months helps a lot there too.
Okay, so controlling costs with DPU is step one. But that residual value piece, what they get back at the end, that's always been the risky part, hasn't it? Used car prices fluctuate wildly.
That's where the magic, or potential magic, comes in. It's this 70% conversion rate from their rent-to-buy program. This might be the game changer.
Rent-to-buy. So people rent it for a few days and then decide to buy that specific car.
Yes, they get a 3-day test drive, essentially. And here's the stat. 70% of the people who do that test drive actually end up buying the car.
70%, wow. That seems incredibly high compared to like a normal car dealership visit.
It's way higher, and that's the linchpin. Because think about what it does to the residual value problem.
Okay. If they're selling direct to a retail customer.
They completely bypass the wholesale auction market, where prices get hammered down. Selling direct, retail, captures way more of that residual value.
Which helps keep the DPU low and makes the whole fleet economics work better.
Precisely. It de-risks the balance sheet significantly. They're not just renting a car, they're using the rental as a lead gen tool for their own high-conversion used car e-commerce platform.
That actually reframes the whole business model quite dramatically. It's less about daily rental rates and more about asset management and sales conversion.
It is. And the big money is noticing You can't ignore the institutional sentiment shift. You've got high-profile investors involved, like Bill Ackman's stake getting attention. Some analysts are even whispering about it being a potential Chipotle moment.
Whoa, okay. Comparing it to Chipotle suggests a huge potential value unlock from something previously written off.
That's the implication. And management's putting out some ambitious targets to back that kind of talk up. They're aiming for a 3 to 6% EBITDA margin in 2026.
Which is pretty aggressive given where they've come from.
Very. And longer term. They're talking about hitting $1 billion in adjusted EBITDA by 2027.
$1 billion. Wow. How do they plan to get there without just, buying way too many cars again?
Through disciplined, segmented growth. They're saying, okay, the airport rental business, that's mature. Expect GDP-like growth, low single digits.
Makes sense.
Off-airport business, maybe mid to high single digits. But the emerging mobility stuff, that's where they're targeting 10 to 20% growth.
Okay, so the story sounds compelling. Fantastic Q3, a smart strategic pivot focused on car sales and conversion, institutional backing. But let's pump the brakes a bit. We have to talk about the risks.
Absolutely, because that history we mentioned, it casts a long shadow. That trailing 12-month loss of $2.55 billion is real.
So how do you square that circle? A massive loss historically, one great quarter. Is it sustainable or just, a blip? Maybe even a dead cat bounce?
And that's exactly why the professional analyst community is still pretty cautious. The consensus rating right now, it's a hold neutral.
A hold, even after that huge earnings beat and the stock surge?
Yep. And here's the kicker. The average 12-month price target from analysts is currently around $4.90.
Wait, $4.90? But the stock jumped to like $5.70 after the earnings, so analysts think it's actually overvalued now.
On average, yes. It suggests they see the recent excitement but aren't fully convinced the turnaround is locked in yet. They likely want to see more proof, probably starting with Q4.
And speaking of Q4, there were some less positive updates to the guidance recently, weren't there? Some headwinds.
There were. A couple of things to be aware of for the near term. First, some kind of external system outage at their vendors is expected to knock $10 to $20 million off revenue.
Okay, maybe temporary, but not insignificant.
No. And second, they flag that they're dealing with elevated fleet recalls in Q4. That costs money and management attention.
And recalls. That could force them to sell more cars at auction. Right. Which hits those residual values we just talked about.
Exactly, which pushes DPU back up. They actually guided for DPU to tick up slightly in Q4 into the $280, $285 range.
So still below $300, but a step back from the trend they want. Shows how sensitive things are.
It does. And then you have the broader challenges. This stock is volatile beta over 2. Competition from ride-sharing peer-to-peer rentals like Turo, that's not going away.
Yeah.
International demand is also a bit weak.
Okay, so let's try and synthesize this for someone trying to decide about buying Hertz right now. You've got this incredible operational momentum from Q3.
Yep. Best utilization in years, positive cash flow, a surprisingly strong earnings beat.
Fueled by a genuinely clever strategic pivot towards becoming more of an asset manager and car seller using that rent-to-buy program.
That 70% conversion rate is the core of that strategy's potential.
But on the other hand, you have a mountain of historical losses, huge stock volatility, and analysts who are basically saying, show me more before jumping in. Plus, near-term Q4 headwinds.
It's a classic turnaround play scenario, really. High risk, potentially high reward. The pivot makes sense on paper, especially that car sales angle, but it's still early days and proving it works consistently quarter after quarter.
So the key takeaway seems to be, Hertz isn't just about renting cars anymore. It's trying to be an e-commerce and asset management company that happens to use rentals to feed its sales engine.
Exactly. And the success of that model, particularly maintaining low DPU and keeping that amazing 70% conversion rate going, that's what determines if this is a true value investment or just a volatile trade for now.
So the question for you, the listener, isn't just how's travel demand? It's can Hertz keep efficiently managing and selling its cars at retail prices? That's the #1 thing to watch.
Yeah, watch that DPU trend and any commentary around the rent-to-buy conversion rates when Q4 results come out. That'll tell you a lot about whether the Q3 momentum is carrying through.